Good afternoon to one another present here. I am Kandasamy Manager ISBA. So we thank all the ISBA members, those who have registered for this event, along with their startups for the today's topic, Fintech Runway for Venture Creation. So our chief guest today's chief guest is Shri Amit Ratanpal, founder and managing director, BLinC Invest in Mumbai, Maharashtra. So sir will interact about venture capital, angel investors, and equity and versus debt finance for the today's topics. So it is an oral interaction only for this. So basic introduction will be provided with the sir. So you can gather the full information. So based on that, we will organize again after 10 or 10 days with a hands-on session. So, okay. So you will get more on the same. So, I will small introduction will come. Amit Ratanpal sir. So Amit is a Harvard Business School alumnus with over 20 years of experience across private equity, capital markets, asset management, and investment banking. He has advised and managed sizable investment and exits along with building strong business across education and financial service sectors. So his previous experience is a director, Matrix Learning Private Limited, Mumbai, investment committee members, Grey Matters Capital, Mumbai, advisor and partner, CBA Capital, Mumbai, director, Advanced Mumbai, as his education is Harvard Business School General Management Program. So also SVKM studies in management studies in finance, MBA in finance. So, and I also a small introduction about BLinC. BLinC is an India-based venture capital fund committed to funding EdTech and FinTech startups, focused on building a better tomorrow by harnessing the power of technology to build and strengthen the product and services catering to the global education and finance sectors. So, sir, as a co-founder approach, as an entrepreneur, the BLinC works through trust and collaboration with the founding teams. They are value builders, providing strong support, platforms, and influential global network to help build significant value in the business. So they are India focused with global outlook, investment in business that harness opportunities to provide a product and solution to the Indian market, which they can be leveraged to scale globally. So they are sector focused on high impact and exponential growth sectors coupled with their own expertise, namely education and financial sectors. So technology as a key enabler, they believe in tech business must leverage the power of technology to overcome challenges through innovation. So thank you, sir, for the today's event to interact with our member incubators. So kindly provide your insights on the financial runway for venture creation today's topic, and question and answer session will be continue with the end of the session. Thank you, sir. Thank you.
Thank you very much, everyone, and really appreciated that you invited me for this particular forum. What I would request you, if you can give me a little bit, 1 minute on the different types of participants are there, because basis that I will also ensure that I can give them insights about relevant topic. And
there are now 16 members are there, sir. Once it's there.
Sure.
So we'll wait. Or...
Sorry?
Once it's there, people, participants are 16 are there.
Okay, and what are the background? Where are they generally?
All incubation managers are secondary level people, CEOs and incubation managers are they are looking after the funding opportunities. The seed fund, no, they are providing seed fund to the startups. So they have to write a proposal for the same.
Okay.
So they have to get the funding from the various ministries and they have to provide a seed fund to the registered startups.
Okay, understood. Yeah. Thank you very much. So a quick, just one, two line. We BLinC fund, as we mentioned, we are 100 crore fund, and we only invest in two sectors, that is education and financial services. And our ticket size can be between 5 to 15 crores, and we don't mind even if they're a good type of opportunity. We also don't mind investing at an incubation on very early stage. But the two sectors where we'll be focusing are only two, that is education and financial services. That's it, because these are the two sectors where we invest only, right? So that's the little bit of a background. And I know there's a, sort of topic was there, which was, related to funding both equity and debt was one question which I think everyone wanted to understand. And the second was angel versus venture capital as well was a second question. In addition to that, are there any more questions which anyone want me to answer? If yes, my request would be that, you can put it in the chat box so that, the relevant question, and I will be to answer them as well. So are there any questions? Just let me know. But quickly, giving you a perspective on two parts. One is the equity and the debt funding. Now, I think the question out here is both comes when it comes from equity. Equity funding, as all of us know, they take participation as a part when a company is being formed. They will be part of the shareholder, depending on the amount or the percentage of equity they own, whether 10%, 26%, there are different rights which has been, even I would say listed down by the Companies Act as well. So that's a benefit of the equity. However, what is the downside of equity is that when we invest into an equity, when we invest in the equity of the company, for whatever reasons, if the company is not performing well, then there is a possibility that the company may wind down and you may not get your money back also, unless until there is a preference over liquidation and something on that line also. So that's one part to look at on the equity. The other part of equity is that the good part is it also has a upside. When we say there is a valuation of the company is, let's say, 1,000 crores and you own 30% of the company, that means you become a 300 crore worth is the asset or the value of the shares that you own. But when it's come for debt funding or debt of the company, at that point of time, if the company's valuation has moved from, let's say, 50 crores to 1,000 crores, you don't get the upside benefit because it's a debt, and the debt is something which will always be repaid it could be repaid with a rate of interest or without a rate of interest. There are rules and governing which bodies, which especially the Companies Act talk about the minimum rate of interest which a company should charge. Otherwise, it is not necessary, will be an arm's length distance. And basis that also, I would say that, one would define what would be the rate of interest. Uh, Obviously, it is non-dilutive. That means you don't have to dilute your equity. So tomorrow, if by raising debt, you're able to move the value of the company from, let's say, 100 crores to 1,000 crores, and you own 100% of the company, the benefit is that you own 100% of the company. You're going to share the value of that company with anyone also. But as a debt holder, I only get my capital as and the interest back. But if the company is not doing well, and if there is a need for liquidation, then obviously the debt shareholder, the debt holder get equity before, much before, I say get the money back much before than the equity holder as well. So these are the two ways to look at equity and debt. The other way to look at it, hey, even if you want debt because it is non-dilutive, will anyone give you debt? So most of the time, what happens is the banks will give you only debt if you are profitable company. Then only they will give you debt, option one. The second is they will only give you a debt where the current cash flow which the company is earning, even if you are not profitable, will be able to service the interest and the principal over a period of time. So that's one option when they will give you a debt. A third would be they will provide you debt, which I would use for lack of better word, a working capital, only when it is for a very short period. Say, for example, you have a receivable from a top quality bank like Deutsche Bank or ICICI Bank or any of the top bank or some of the large companies like ITC. You know that ITC or ICICI Bank or some of the large companies will not default on, the principal interest. Then you don't mind giving that particular company a debt or a working capital loan for that 15 days, 30 days, or 45 days, saying that whenever you receive the money from ITC or ICICI Bank, you will repay it to us. That is what called as a receivable financing or a working capital loan as well. So people would do at that point of time, or that's the time when people will be ready to give the loan. But most of the time, SME will get a loan for a period of between 2 to 5 years. It can be even a lower period as well, but it is always generally for a very, very shorter period because anyone who is giving a loan will have a visibility of that particular business doing good or not good between 12 to 18 months. Unless until there is an asset which is been backed. This is something which I'm talking about more of unsecured loan as well. So this is where people will provide debt. So again, from a debt and equity perspective, if you really look at it, is that if you know that you need money for a long period of time and you are not sure whether your business will do good or not do good, then it is better to raise equity because you will have an obligation, both personally as well, if you're on the board of the company, to ensure that the debt is repaid, or otherwise it will start impacting your CIBIL score as well. So, but if you know that you can repay the money requirement is for a short period of time, then obviously, people would raise debt also. And obviously, everyone knows that debt is cheaper than equity. Like, and I'm giving you an example, if today the debt cost is say 14, 15, 60%, then equity cost would be anywhere between 25 to 35% as well. So this is the difference between equity and debt. I'll pause right now. If any one of you have any specific questions around this. Yeah. Sure, Raju, tell me. Hello? Sorry, I'm
Harshit, Rajarajan, who wants to talk? Rajarajan, sir? Any questions?
Okay. If there are no more questions, then probably I will go to the next part, which is angel versus venture fund. I think that was also one of the questions which was been told to me as well. Is it okay to go to the next topic?
Yes, sir.
Okay. So I think the difference between angel and the venture capital or private equity is basically depends on the stage of the company that you are, right? So today, when the company is merely on paper, where the company is yet to be formed, probably sorry, you will require some capital only to either launch the product or to do a little bit of technology development or something like that, which people say it is mainly for product development. And that is the time people would go and raise angel amount. And usually the angel amount that people are raising will be anywhere between 1 to 5 crores. As a thumb rule, there are people who have raised more than 25, 30, 50 crores, but I'm not talking about that. But as a thumb rule, I'm talking about the angel round one would raise between 1 to 5 crores. There is a thin line between incubation money raising and raising money at the incubation of angel. But most of the time, we have seen that while the companies that would come to you in your incubation center also, they are also funded by angels ultimately. What is angels? Angels, all of us know, is someone when believes or trusts that two, three, four individuals who just have a merely an idea and nothing else. The product is not ready, nothing else, just a beautiful PowerPoint presentation. And they're just telling you what this particular idea looks like and what is the opportunity look like. And they give everyone a comfort that they will be able to develop this particular technology or the product, and there are a lot of these benefits out there. So this is the time when they would raise, as I mentioned, between 1 to sort of 5 crores to prove that concept, to prove this idea. And because they're trusting this individual, the people who invest, the investors are called angel investors because they're just becoming like an angel. It's more of sent by God. That's for a lack of better word. It's how they've sort of named it. So that's the time at the angel. The dilution at the angel round, and I'm just putting a thumb rule. If someone would raise for 1 odd crores, depending on quality, the dilution would be anywhere between 5 to 10%. And sometimes it is 15%, but mostly we have seen For 1 to 2 crores, the dilution is between 5 to 7%. They don't dilute more because this is the time it is just about proving a concept or proving a product and nothing else. Once the product has been ready, obviously they have to start doing some sales because the product is ready, but the product gets only real product when someone buys it. The customer is ready to buy. At that stage, they need some money. And at that point of time, when they raise money, it is normally been termed as very near to called seed money. But I will say that angel money investors are already giving you the seed money, so it will be seed plus money, but it will be still part of the seed formation, maybe very early stage of VC, because you have created the product. But what people say, the product market fit, that is this particular product liked by the customer, not only liked by the customer, are there many customers who are going to have it? And is this a business opportunity which is large enough or it is niche? And when I say large, from my definition or BLinC's definition, it is that, hey, do you think this can become 1,000 crore revenue or 2,000 crore revenue company or not? If not, then we know that it's a very smaller company or a very small opportunity out there. So that's the eye lens in which will people look at it. So the product market fit becomes a very important part and a very relevant piece for everyone to understand. And that's the time again now where they will raise 2 to 5 crores, where they create a sales and distribution team to ensure that the right type of customer buys the product. And there is a lot of attrition or the changes happening in the product stage as well. Now, because of the changes in the product and a lot of other things, the right, what, as I mentioned, product market fit is gets established. And once the product market fit gets established, now they know that there is a market. Now they need money for growth, and which is what we call it as venture capital. It's not truly growth because you're not created a 10 crore of revenue per month. We have just created maybe 5 lakhs or 10 lakhs of revenue per month. And this is the time when you need between 5 crores to 30 crores to move really and becoming a reasonably large company. You need money for better technology development, to create your sales and distribution team, to create a proper organization. Because at angel stage, probably you were working with 5 to 6 people, 8 people, maybe 10 people. Angel plus, which is when you want to do product market fit, you maybe had a couple of more people, maybe 15, 20 people. But now you need to create a sales distribution, customer service, HR, finance, because now you believe that there is a market opportunity, 1,000 crores of revenue can be created and a lot of things can be done. And this is the time when you will go and raise a larger money and do a lot of things. And this is where the venture capital business comes into. And this is a time when they will fund you so that you can really become a bigger company. And probably the expectation out here is that they will invest when the company's revenue is between 1 2 lakhs of revenue per month to maybe 1 or 2 crores of revenue per month. And that's the time they will go ahead and raise money from the venture stage. After the venture stage, let's say you raise money, you're doing very good. Now the company is doing, let's say, 5 to 10 crores of revenue. This is the time you know that it's 100 crore revenue, a lot of things can be done. The company may need still more money, okay, for growth, building a stronger team, better technology, better customer service experience. A lot of other things are going to be required. And this is the time when I would say the growth funds comes in, which is nothing else but a venture capital fund, oblique growth fund, or for lack of a better word, again, it's a P fund, private equity fund comes in, because now you read between 50 crores, 100 crores, or maybe more also to take you at the next level. And this is where the big boys of the PE comes in. So as I mentioned, there are 2 3 different stages of the company from a funding perspective: angel, venture capital, and the PE stage. I described the 3 stage. The company may go through different journey. For example, it may be at incubation stage when they're just conceptualizing and trying to understand whether this product works or not. They'll do a market survey. That's where some of the incubators like yourself will work them very closely. Once they know that there is a market survey and a market opportunity, they'll create a product around this. And once they go ahead and create a product, then obviously they will go and market fit, and the entire journey starts thereafter. So this is the overall life cycle between angel versus venture capital. I'll pause right now if you have any more questions around this. Any questions? Hello?
Hello. Members can ask questions, please. If any doubts, no, in the each session, can you ask? It is an important session, so kindly use this platform. So you can easy to fund your startups, no?
Or any other questions, because these were 2, 3 topics that were being given to you, given to me by, I'm assuming, all of you together. But if there are any other topic where you want me to have a discussion or anything specific to education or financial services, also more than happy to discuss about, or any area as well, like what should be the go-to-market strategy, what should be the product market fit, what has been my experience of my portfolio companies, happy to discuss that. I think Ritik Kumar wants to ask something. Hello, sir, they've written, so I don't know. Yeah. Yes, Ritik. You can talk also in case it's possible. Ritik, are you there? I think Ritik has dropped off. I don't know. Anyone else? How to convert non-paying? Yeah. Ritik, can you speak if typing is taking a while? Can you speak? Now to convert. Okay. I think the question that has been asked to me, how to convert a non-paying user to paying. See, in my view, it is very, very simple. Uh, if the customer values your product, they will always pay you. So that's how I look at it. And I think one of the, what people call it, that, hey, let me create funnel and first create awareness and then I'll convert them to paying the product, because that becomes a value addition and all that. That it becomes a value addition and all that. Then, I don't think so that most of the time works. If a customer values your product, please ensure that they give you the money. That's one. A lot of companies I've seen that, okay, let me create that awareness, let me create a lot of databases, let me ensure that people love it, and after that we will think about some mechanism for monetization of this. In my view, such model 99% doesn't work. Selectively few companies, which is probably Facebook, probably LinkedIn, in the early days they were not clear what would be the business model, but they just wanted to create a community and it got evolved. But most of the time, my view would be, if there's a product ready, the customer needs to believe on that and they have to pay for you. Or if they're not valuing the product and not paying, that means that probably the product you have developed is not a must to have product, is a good to have. And must to have product, they will always pay. Good to have will be always the less priority and they will always pay less as well. So my view is as follows, Ritik, on this at least. Okay. Any other questions? Anyone else? Ritik, I hope I could answer your question. Okay. If there are no more questions, probably I will open up to one more topic. I think most of the companies that you are facing would be at the incubation stage, right? And at some point of time, they will need funding. And two, three question comes in, what is the best way, what time to raise money, how to go about, and all this piece, right? So my first view would be get the product market fit right? That who is your, uh, who is your customer, right? Or why someone is going to buy this? Because if the product market fit is right, then the venture capital funds or even the angel funds, or even for that matter, there are a lot of marketplaces who helps you to raise money through the angel network will be very, very keen and excited. So it's very, very important to get the product market fit. And that is the time when one has to spend a lot of time in tweaking the product or the business model or the approach, to be sure that people are buying this particular product and they truly believe that there is a value addition. That one point, I think it's very, very critical before you go. Second piece is when you approach any of these angel funds or a VC funds, what is important out here is not the 40 slides or the 50 slides or the thing what to do. In the first meeting when they go, which in my view is the most critical meeting, what a VC fund or an angel investor want to know is a very summary format of top 4, 5, 6 things, such as, hey, is the particular team enthusiastic about this particular business model or approach? Is this team particular really passionate about it? Do they have a depth in the understanding the particular business? That's one. B is in a very summary form in probably 20 minutes, probably 25 minutes, ideally even 15 minutes. They would like to know what the business model is, how large is the opportunity, what is the opportunity, what we are trying to do. When we email the deck to any potential investors or have that first call over a Zoom, the objective is only one thing. When we email the deck, please ensure the deck has the most simple, relevant, and to the point information such that a call has been arranged. When the first call has been arranged, the only requirement, or to put it very simply, the need of the day, hour is what? Hey, you know what? Please meet me face to face. I like what I heard with you. When you meet face to face is when the story starts, in my view. Because when someone meets you face to face, that means he truly believes in something, he truly likes it, or say that, you know what, I like the call. You are in two different cities. Maybe we cannot meet face to face, but let's have a longer, proper Zoom call. And then when someone is having a proper longer Zoom call, that part of time, their people are very serious because they're prepared. They ask you all the relevant questions, all the deeper questions. That's the time when the startup truly need to be prepared. So these three stages of fundraising, one needs to be very, very mindful of how to approach them. And many times we receive a deck where it takes us probably end of the deck to not even figure out who the founder is, what is the business model, what stage it is, what problem they're trying to solve, or who is your customer, is it truly an opportunity? And that's where we struggle and we what we do, because for example, I receive on a daily basis about 4 to 5 presentation between edtech and fintech. Now that means in a month almost we would be receiving approximately 50, 170 presentations, right? It's practically impossible for me to speak to 150 founders in a month. It's practically impossible. So what we do is we'll boil down merely by looking at the present, reject because of multiple reasons. Thesis not been fit. We couldn't understand very clearly what the business model is. It is not relevant. So we boil down to 20. Mr. Sundara, yeah, can you put we boil down to Mr. Sundara, can you put it on mute, please? Yeah, thank you. Yeah. Someone put Mr. Sundaraj on mute. Yeah, thank you. So we will from 150 we want to only speak to about 20 to 25 founders. And from 25, we just want to get engaged with 3 to 5 whom we believe seriously, because it practically become difficult for me to engage with all the founders. Hence, this 3 stage is very, very important. That remember, from 155 is the only percentage we want to look at. So if you really look at, it's about 2 or 3% of the team whom we really want to have a call, or maybe even want to, a word talking, where we believe is, because every company takes a good period of time for us to do due diligence as well. So just be mindful as your company is in the process of raising money as well. Again, I'll pause. If any one of you have any questions around this topic, happy to answer. Or any other topic for that matter. Yes, there is a question from Ambuzami. Cash flow management software such as Zoho, yes, it comes under the part of the fintech piece, because in our definition, we made it little broad based, where fintech includes financial services and finance and accounts, because it's a little bit of extension of fintech. So yes, it does include that as well. So there are accounting software which is a new age software, unlike the Tally, which is still relatively old age. Nothing wrong about Tally. And there are software which automates a lot of things, including budgets and other things. We would be more than happy to look at it as well. Yeah, so if any of your companies are there in EdTech, FinTech, I'll just put my email ID on the group. You can always email it to us, and happy to look at that. Again, any other questions? Okay. I'll go to my last topic, which, if there are no more questions to this, is that specifically when you are at the incubation stage, right? What we have seen is that many times one wants to build an ideal product. Remember, it's never about the best product. It's about the product which is the customer likes it and likes it and can start using it. So my request to everyone would be, make a product which you can put it across to the customer, take customer feedback and start improvising from there onwards, rather than only focusing on an ideal product, because there's nothing like an ideal product, right? It's a continuous evolving again and again and again. The Facebook type of companies, which was X when it started, or Amazon or Google, it completely changed. Who knew that Google will come out with Google Maps as well, right? No one knew about it. So it completely transformed over a period of time. It changed it and thought differently, right? So it goes through their own innovation. So that is one thing. B is, many times when we create a product, we have to be very mindful that A, it's not about solving all the problems. You cannot practically solve all the problems. Like a mobile has so many apps, but practically how many apps or anything we use? Probably email, WhatsApp, SMS, calendar, watch, maybe 2 or 3 more apps, that's it. Or 4 apps, 5 apps, that's it. And it continues, it goes down, right? So what I'm trying to put it out here is try to solve customer the most important problem, or the most, probably 1 or 2 problems or 1 or 2 issues of that, but don't try to solve all the problem. It's okay for some of the problems not to be solved, and always think about prioritization. If you're solving 60, 70, 80% of the problem, you're solving a big problem for the customer. You can't solve all the problems at all. So don't spend too much of money in getting the ideal product, or waste too much of time on creating the ideal product. Focus on what the customer needs are. Focus on what you can give it to the customer at this stage, when the customer feel good about it, happy about it, and thereafter you can move to the stage 2, 3, and it's a process, right? You have little money, you have time as a constant, you have everything as a constant. The customer is always evolving. There is a competition, so go to the market fast, fail fast. If you know that you build a product, it's not going to work, close it, move to another level of product, change it, rather than creating an ideal product and realizing that, hey, this is the product didn't work, and oh shit, I've wasted too much of my time and everyone's time as well. So that's one more part which I thought I will share my views around this as well. Again, I'll pause. If you have any questions, happy to answer. Or any other topic?
Sir, this is Kannan from Kongu TVA. So, if you don't mind, can you just bit elaborate on the product market fit so that the age where the investors will be keen to invest or fund them. So
Yeah.
there will be a lot of issues like what problem solution fit to product market fit. The stage at which the investors will be more interested. So you can just bit elaborate so that everybody gets.
Sure. Just give me 1 second. Just 1 second. Yeah. Sorry. So when you talk about the product market fit, what is really means is that let's take a very simple example. I'm a customer and you create a product, and the product could be as simple as that. Hey, I'm going to track your expenses on a day-to-day basis, right? Now, when you create the expense management model for an individual customer like me, right? What are the top 2, 3 things what I will track, right? Could be my grocery bills, could be my medical bills, could be my ABC bill, right? Now, in that particular case, if you create a product, what is that? Is this product must to have or good to have? Is this product where the customer truly believes that it's going to add value, or creating one more app, or maintaining is becoming a literally a nightmare, right? That's one piece which one have to look at it. The second part of this expense part out here is that if you know that no, it is a good product, this what are the 1 or 2 or 3 big items they need such that people will start using it. So ensure that features are definitely available. The third part is the ease of use. It should be so easy that even a dumb person can understand it, right? Because we are talking about, in general, a simpler product as compared to what was earlier, available or if not available as well, easy to use. And the fourth is that, is the customer ready to pay or not? And last but not the least is the market size large or not? Now, if I create a great product, but the market size is just merely 50 crores or 75 crores, I'm just putting a number to put a point across, then probably you may have a product market fit, but the market size is very small. And probably you will realize that you don't want to get into this, right? Or the pricing of it. You may launch an app and you believe you have created one of the best app in the expense management, and you start pricing 5,000 rupees per customer, right? The customer says, hey, 5,000 rupees, why should I pay? Probably I'll buy a small book and I'll start maintaining my expenses. That's easier, simpler, or maybe in an Excel sheet, right? So at that point of time, the value for the money they paid is what people will question it, right? And these are all the things which comes at it at product market fit, and that's where if you and everything is to a certain category. Like everyone knows Bata 99.99. Why it was 99? Because they realize that psychologically also that 199 plays a different piece. It's a product market fit that a customer start loving it. Or for example, nowadays people have started calling the world called fine dining. It's a product market fit for which type of a customer? The customer who are ready to pay more, who want a very, very good ambience, who want the plates to come in the most designed format. They want the food to be, very much designed. There is a different customer set of customer for that. That's a product market for that geography, that location, right? Now, think about if I go ahead and create a fine dine in a village, there's no product market fit because in a village, they will not appreciate. They want just a good taste of food. Or again, give you example, food is if I go to a particular place where we know that people in general, or if you go to the US and you launch a restaurant where you can have the most spiciest food, and we know in general people in the US are not having spicy food, then there's no product market fit because the customers are not going to accept it, right? Or launching an IB school in a tier 4, 5 cities where the aspiration is just to ensure that the kids or the children are ensuring that they complete the school, right? Their objective is not to go overseas or not to have the best of education. I'm saying IB doesn't mean the best. I'm just giving you that IB is generally high prices compared to CBCIC. So putting it from that perspective as well. So this is where product market fit perspective comes in place. I hope it answered some of your questions, or partly or fully.
Yes, sir. Thank you.
Anyone else? Any questions? Yeah, I think this is interesting. If a competitor has raised money for similar value proposition, should we also try to raise money in order to catch up? Well, it all depends on your aspiration, the competitiveness as well. If the market is very, very large and you believe that it is better to raise money so that you get the first 2, 3 people advantage, absolutely yes. But if you believe that it is okay not to raise money because we are creating to a particular product market fit, and that where you don't need money, it's okay. Like for example, Swiggy, right? And we have seen that delivery space, uh, there were only 2 players or 3 players, and it was very difficult for the fourth player to come. And they went out and raised tons of money to capture the market, because once you get to Zomato or a Swiggy or whatever, app, it will be very difficult for you to shift. And there were only 2 people who survived. Or for example, in the between Uber and Ola, there were only 2 people. There were taxi for sure, but that got merged with Ola. And if someone would have launched fourth or fifth company at that point, it would have been very difficult for them to really create the market, because already people had captured the market, the size was relevant and all that. So yes, it all depends on the market opportunity and your aspiration as well. I hope, Mr. Abu, it answered your question. Thank you very much. Any other questions? Happy to answer. So, team at ISBA, I think 3, 4 topics which were given to me, I have already sort of gone ahead and shared my views on this. But if there are any specific questions, happy to answer, or I'll be guided by you as per your what are the next steps of this. Sorry, team at ISBA, are you there? Someone?
So what percentage shall we fix for the startups, equity percentage, or equity model?
Sorry?
Percentage of returns, So we are providing a fundings to the startups. So we are getting a return on investment. Okay, the incubation center has to return the same from the startups. They have to get back. So what's the percentage we will fix for this?
Yeah, are you talking about percentage of equity or percentage of return expectation?
Percentage of returns, sir.
See, today, and my expectation would be, because if you're looking at incubation stage, which is super high risk and super high, you can lose the money as well. My expectation would be that you should be at least getting to 15 to 20 times multiple of your money. So, for example, if you invested 1 crore, you should expect every startup to give you 15 to 20 crores, or more than 40-50% higher. The reason is because, specifically in the incubation stage, we have seen, if you're looking at 100 companies, 90% or 95% of the company fails and they don't do anything. So it's that 4, 5, 6 companies which has to ensure covers the 90 or 95% of the companies which fail. So your expectation should be that at least 15 to 20 times multiple return. Anything lower than that, in my view, will be difficult for you. And the reason when I use the word difficult for you means it may not justify the risk that you are taking, because it's an incubation stage.
Okay, thank you. Any other questions?
Yeah, one is, what are the basic steps we need to do achieve to get angel investment? I think the basic step, as I mentioned, angel is more at a very, very early days, at a days when the company just have business plan. Uh, do your homework thoroughly. When I say homework thoroughly means how large is the market opportunity, who is your customer, why customer you want to buy, and what business problem you are trying to solve the customer, and what is the business model. Be super, super clear about that. And work, that's a hypothesis because it's incubation stage. But my view would be one needs to be very, very clear at this stage about this 4-5 aspect. Because today, think about it, someone say, oh, I want to provide EV funding. My first question would be, how large is the EV market? I'm not sure. Okay, why will the banks not provide EV? I'm not sure. Then you have not done your homework, right? So with that, you need to be very, very thorough and more clear about how large is the market opportunity, who is your competition or where the competition lies. Uh, the third is who is your customer, why the customer is buying. Fourth is what is your business model, what problem you're trying to solve, right? So these are the 4-5 aspects I think plays a very, very important role. Any other question?
So is there any specific thing like what would be the stage or startups which may go for debt or equity? So
Yeah, so I did answer these questions in my earlier, discussion right way. But the main question out here is that are you able to service your debt, right? You may want to raise debt, but you may not even be able to raise the debt, right? Because the company itself is not ready to provide, either the company cash flow will not be suffice enough to be able to pay you debt raise also. If your project requires a long time before you can start looking at revenue and a true profit, obviously equity is always better, right? That's how I would also look at it. So I would say an early stage company, my recommendation would be please don't raise debt. Focus on equity because you are yet to finalize your product, yet to get a proper business model around these. A lot of question marks are there, and hence it may not be worth for us to go for debt. I hope it answers your question.
yes, sir. Thank you.
Any questions? Shall we close the meeting?
Hi, sir. Myself Jay Kumar. We bootstrapped and we developed the product. We developed a hardware product and still now we are bootstrapping. What are the basic things the first question I will ask the basic steps we need to do for angel investing. So we are planning to move ahead from bootstrapping to investment. So what are the things we need to do? Like we already product is ready. Our first version of product is ready. So can you let me know points like which can do to get an angel investment?
Yeah, I think the requirement is exactly the same which I told just about a few minutes back. Nothing. You need to because today your PPT is to be ready. Don't make a 50 slides PPT, which I mentioned to you. Also make a very crisp PPT that's 7-8 slides where when you email the PPT, someone truly understand your business model, truly understand the market opportunity, believe it's a rockstar team. That's it. You don't have to send. No one will buy a PPT. What is the objective when you email the PPT? Hey, let's get into a Zoom call. When you do a Zoom call, what is the objective? Let's do a face-to-face meeting. So limit itself in the first 2 events to create enough excitement. Don't get into and sell the entire investment as if he's going to write the check. That never happens. So just be very, very mindful of that. What we see in Shark Tank is not real in the normal world.
Okay. Thank you, sir. Yeah.
I think there's a question once again from Mr. Abu Jami. Sir, for angel round and VC growth round, should the company raise according to the remaining runway or according to the growth revenue they generate? Always the runway, right? Because end of the day, if you know you don't have money, both is important, right? Because it's a correlated. You're doing a particular growth, you're doing a revenue, and if you're not profitable, that means you're burning the money. If you're burning the money, that means you know what is the runway you have. And my thumb rule would be that you should always, at any point of time, you should have 12 to 18 months runway. As in case you have lower than 12 to 18 months runway, you are always at the edge on everything. So that's the question answer, Mr. Bhuzan. I hope it answers your question. Yeah. Okay. Any other question?
Any questions or more, or we will wind up, sir?
Okay. I think it sounds good, sir.
Yeah, yes. Sir. So thank you for your good presentation, sir. So
Thank you.
good. Actually, members can utilize this platform. So can we organize the same event for the attendees, no, those who have participated today, even as a hands-on session like that?
Sure, sure. Not a problem. More than happy to do it. And as
a
I mentioned,
calculation part, as a
Yeah.
calculation part like that.
sorry?
As a calculation part, no? How to?
Sure.
Okay, okay.
No, absolutely more than happy. And as I mentioned, if any of your companies are in education or financial services, we are happy to look at them for potential investment also.
Sure, sir. Sure.
Super.
Thank you all attendees with along with the startups and incubation managers. So thank you, sir. Thank you for today's guest.
Ratanpal.
Thank you all.
Yeah.
Yeah, I'm wishing all of you a very, very happy new year. And I hope that the startup world sees a new horizon in 2024.
Can everybody switch on your videos? Actually, it will be in the fine. It is a recording, is ongoing. So we will post it through every social media web pages of ISBA. So kindly everybody switch on your video files.
I hope the session was give you some insight, not of everything.
Yes, sir. Thank you, sir. Thank you all.
Yeah, and I've already shared my email ID. So if any questions you have, anything which you require questions, happy to answer as well.
Yes, sir. Thank you, sir.
Okay.
We'll in touch with you, sir, for the future program. After 10 or 20 days, I will call back again.
Sure. Absolutely. More than happy.
Thank you, sir. Thank you all members. Bye.
Bye-bye.
Thank you. Shall we wind up now? Okay.